welcome back. You're watching The Money Show on ET Now. Well, this week we have a beeline of companies queuing up to go ahead with their IPOs. That's essentially to list on the Lal Street, post which we'll be able to trade and invest in them in a more easy fashion. IPOs are when companies go public for the very first time, and they give the opportunity to everyone, from institutional investors to the more sophisticated ones, to the HNIs, to retail investors as well. So this is an opportunity for you to invest in a company for the first time before it's actually going public. So you subscribe to the shares. But how do you do that when you don't know much about the company? Yes, there is a DRHP that is given, and it has a plethora of information, but going through all of that information, making sense of it, can really be quite a tedious task, especially if you don't have much in terms of a financial background. So we decided to explore this topic on how to judge an IPO. What are the factors that some of the most astute and expert investors out there look at before they make a decision to subscribe to an IPO or not? I have with me one such investor, Deepak Shenoy, the founder of Capital Minds, who joins me on the show right now. Deepak, thank you so much for taking out time and joining us on the show. Deepak, so many IPOs, since I guess September or October, and now this week as well, we are spoiled for choice, if I could call it that. We have many more coming up as well. So what do you look at, Deepak, before you decide on whether you want to subscribe to an IPO or not? What is on your checklist, your list of parameters?
So, Mubina, I think the big problem with IPOs is there's not enough information of the past in terms of balance sheets. But the good thing is you get a DRHP, a draft red herring prospectus, and the first set of lines that they write in there is the risk factors. So in the risk factors, they actually tell you a lot of things. Some are very boring. It's like, if India got attacked by a foreign power, of course we will lose business. I mean, that's so obvious, you kind of want to ignore that. But there will be some specific risk factors related to their business. In some businesses, they may tell you, listen, we don't own our brand. Our promoter owns it and we pay him a royalty, and therefore we're at risk in case that that arrangement no longer exists. Another thing they may tell you is that we don't own any buildings, or we rent our entire infrastructure, and that can the cost of that is not frozen in time. So we cannot give any guarantee. So a lot of such risk factors are what overall give you an idea of how risky or how potentially good the business is, apart from, of course, the financials. So the next part I look at is the financials to see how well they've conducted themselves in the past. There will be a lot of one-off items usually in the last couple of years, because people dress up companies for IPOs. So you'll see suddenly that certain items in the profit and loss statement would have changed color in the last 2 years, and that may not necessarily sustain. So that's something that you have to be careful about. The last thing, of course, is about how well subscribed and what size the IPO is, and what they are willing to do with the funds. So sometimes it's just promoters or investors selling. The company doesn't get any of the money. So at this point, you're making a bet on the current business of the company. That means the business itself should be growing already. In other cases, the company is raising money for itself. So you have to now check about whether that raising of money is going to give you a substantially higher return, so that the current numbers can be augmented by maybe increasing profits 40%, 30%. That's what will give you the raised valuation in the future. So these are the broad elements, and then there are softer elements, but we can go through that. That's more specific to IPOs rather than general characteristics.
Now, Deepak, you mentioned draft red herring prospectus of the DRHP. That's a key document, and there's very little information, again, like you mentioned, when it comes to an IPO. So how do you, what are the documents that you read? And also in that thick DRHP, which is comprising 200, 300 pages, what are the points that you watch out for and read?
So yes, the risk factors will be among the first. So they talk about the risk factors. Then there's the consolidated, restated financials. They typically restate financials based on whatever else they've done. There's also a section on shareholding and ownership. This is very boring, but if you want to see how the shareholding has evolved over the last few years, you can see whether the share prices have consistently been going up and they've been able to place to well-known investors in the past. So these are small factors that you might be able to look at. Of course, there's also one thing called the objects of the issue. So the objects of the issue tells you whether the company is raising or whether it is being sold by by investors rather than the company raising money for itself. So you can find out what they actually plan to do with the end use of that money. Now, we've had a recent IPO where a company said, listen, we're not selling any shares, but our promoter is. But the promoter intends to give back a loan that he has taken from us. That's a company that's going IPO through the proceeds of this issue. Sadly, that did not come about. So the stock fell 70% after the IPO, and it's still struggling to reach those even the IPO levels 2 years after the IPO, because the promise made was broken. So it's important to see the promises that are being made and whether the company intends to or can keep them, and that will be in the objects of the issue.
Deepak, you mentioned a couple of soft factors. Could you enlist, and elaborate on what these soft factors are?
So the softer factors are specific to companies. So it's about management. You'll have to do a little bit research into management and their past history. Some of them are very new to the market, so that does not give you much room. But some of them are older hands who've probably been promoters of other companies before which were listed. So you can see how they behaved in those other companies as well. So it's the softer aspects of management that will give you an idea of how likely it is that this company is a long-term good story. The second part is, of course, the elements of the DRHP which talk about various competition. So you want to corroborate that data with whatever the competition is releasing as well. So if somebody's talking about market share and they are at X% market share, then you want to see if the other companies that are mentioned, many of them who will be public, have a similar view of those of that market share itself. We've seen in the past that market share numbers are often subjective to whichever company is doing the survey. So it tends to be very, so numbers like this have to be verified in a kind of a softer way outside. There's other things, for instance, the demand for the IPO. So who all are looking to enter the IPO, and is there a broad consensus on the foreign investment or the institutional part of the placement, and is there only retail that is the concern? Because sometimes the institutions don't want an IPO, retail ends up subscribing quite a bit. In other cases, institutions want it, and retail also, of course, enters in. But the reason I see that is because it gives you an idea of whether you can get enough in an IPO. The problem is, if there's too much subscription, you'll just apply and you'll get like one lot, and that too if you're lucky in a lottery. That's a waste of time. You might as well wait for the listing to happen and then look at the stock after it lists. It's okay to take 13,000 rupees and get a 40% gain. But if you actually have 5 lakh rupees to invest, then this 13,000 rupees 40% gain is nothing for you. So it really sometimes differs based on the demand that you might see in the market. There's also, of course, the simplest way to look at it also is how the aspects are when management talks about way too optimistic about the future? Are they more practical? Do they care about long-term value or more shorter-term in nature? And how the IPO in general is being advertised. These are I can't put these in words, but it's easier to, if you've been through a lot of IPOs, you'll find out when somebody is just making things up and somebody is just, giving you an advertising jingle rather than the real story. So those are the softer aspects. I think IPOs are very subjective, and it's very difficult for the retail investor to gauge whether these are good investments or not because there's so little information. So I'd say even if you like a company, plan to pick it up over a period of time as the company demonstrates its excellence rather than just jump in only at the IPO.
Okay. Deepak, let's talk about the red flags. I mean, there are so many IPOs that we have seen recently, and I'm sure you've obviously not subscribed to each and every IPO out there. So what is it then that made you stay away from an IPO? If you could share some examples, it would aid our viewers as well in understanding the same.
So one, for instance, is if you see an IPO in the top of a cycle. So I think the steel cycle is reaching a top or close to a top. So I wouldn't buy a steel company IPO right now. It may be a great company, but I just don't feel that, I wouldn't even buy Tata Steel at the top of the cycle. So I don't think I'm going to buy an IPO at the top of a cycle. So that's one of the things that I care about. And the another thing is, for instance, if the revenues of a company aren't from its core business. So there was an IPO recently where a technology company had been making money in the past from sales of some coal-based products or something like that, and that was it was not in the lines of I was thinking of as a core business. So I said, okay, I'm going to give this at least 2 or 3 quarters and see how they actually generate money from the core business, and then take a look at whether I want to invest. In some other cases, like in the story that I talked about, the promoters were actually in, let's say, in a fix because they didn't have enough money. And they were doing the IPO to raise money, but they owed the company itself a lot of money. So I was a little circumspect about that because I was like, okay, if they don't pay, then we have a problem over here. And they were a very well reputed group, no doubts about their reputation at all. But unfortunately, my fears did come true, and the company did have issues in using that money because now otherwise. They're a cash generating company, and now they're sitting on being owed this money from promoters, which they can't touch, and they'll need to raise money to be able to use it in other assets. So it's a little bit of a governance problem. Those are the things that drive me away actually. Otherwise, IPOs in general, there's very little information about how the future will pan out. So it's almost always better to buy only a little at the IPO and add on more much later.
Well, Deepak, with that, we are out of time, so we will have to wrap up this segment. Thanks so much once again for joining in, Deepak.